Thanks everyone for tuning in this afternoon, and appreciate all of the presenters that we've had today. I'm going to be talking about trail stops, and particularly the best trail stop techniques that you can use for both day and swing trading. I am both a day and a swing trader, and I pretty much use the same techniques across the board. So regardless if I'm on a small intraday time frame, a daily chart, a 30-minute chart, I'm looking at the same types of ways to manage the trade. So a couple of the things that we'll talk about today. We'll hit on how to set profit targets that are most likely to be triggered, and we'll talk about a couple of specific trail stop techniques that I use that you can employ in your trading as well. And then we'll talk about how you can stay in those winning trades longer so that you can capitalize on the profit potential. I do recognize a handful of the names in the room here. I will be keeping my eye on the question box as well. So if you do have questions, feel free to type them in there. And for those that are unfamiliar with myself, my name is Tim Racette, and I have a blog over at emoneymind.com where I kind of share my trading strategies and just overall trading journey and thoughts that I have. I've been trading since about 2006. I'm originally from the Chicagoland area, spent some time down in the Chicago Board of Trade, and a lot of the pit traders down there were pretty discouraging for younger folks to spend time working their way onto the floor. A lot of the traders had already moved to the screen, and a lot of traders in the pits were even looking at charts and then going into the pits to actually place their trade. So I was lucky to have a pretty good set of mentors that were more screen focused, and that's how I really got my start down in the Board of Trade. So I swing trade stocks primarily, as well as day trade futures. I'm not a big proponent of hanging on to futures contracts overnight, but the way that I swing trade is a lot like the way that I day trade, and we'll talk about some of those techniques as well. I've had the pleasure of speaking at the Traders Expos, Money Show, CME, and the likes. And I always enjoy getting outside and getting away from the screen as much as I can, because it does tend to help improve my focus in my trading. So some of the things I like to do: get outside and hike. I'm a big mountain biker. I spend a lot of time exploring all over different fun places, both by bike and by foot. I am an ASU grad, and since leaving the Chicagoland area, I am now a full-time resident of Arizona. So spend a lot of my time in sunny Arizona, and then try to get away in the summer up to higher elevations and escape some of that summer heat. You can find a whole bunch of videos that I've done over on YouTube, and I'm also on the Facebook and the Twitter in the usual places. So let's dive into what we're going to talk about today, and that's trail stops. And first, before we do that, I want to talk about how you can set profit targets. A big part of my approach to trading is to get into a trade with the full position and then work my way out of the trade in kind of multiple parts. So if I get into a trade and it goes against me right away, well, then I'll just get out of the whole position right away. But if it starts going in my favor, I don't want to get out of the position too quickly and be left with one or two contracts by the time the thing starts actually running. And so for those of you that day trade, you probably look at something like the E-mini S&P, and you'll notice that the ES tends to chop around a little bit sometimes at your entry. A couple minutes go by, it's kind of sitting at your original entry, hasn't moved a lot, but then once it gets away from your entry, that's when you can really capitalize by leaving a little bit conservative stop, but still having the ability to catch a bigger move. So I like to do kind of a two-pronged approach when it comes to taking profits. And the first part of that is setting a small profit target. So if you're trading, again, example here with the ES, I might typically use a 2-point target for the first portion of the position. And if you've only got 2 contracts, setting one of those contracts at a 2-point target and then trailing the second contract allows for kind of the best of both worlds. Because what'll end up happening is if you try to go all in, all out on every single trade, you end up looking at what the last trade did, and you might say, oh, well, that was a big runner, and I just got out for a point. So this trade, I'm going to trail my stop. And so on this particular trade, you trail your stop, it goes exactly 2 points and turns around. And then the next time you place a trade, you say, well, yeah, the last trade, that only went 2 points, and I tried to trail. So I'm going to just set a 2-point target, and then the thing runs way past your 2-point target. So using a small target for a small portion of the position when you're intraday trading is really, really helpful. If you're swing trading, using like a 3-to-1 reward to risk as kind of a ballpark for your target is really helpful. The other thing you can do is use like 20% beyond highs if you're getting into, say, a long position that is looking like it's going to break out. You can use a very simple Fibonacci retracement, use that negative 23% target as an exit point. Like I said, with intraday trading on the ES, using something like 2 points, something that's likely to get hit on most of the trades. And that way, when the market may not be getting a lot of follow through and big, 10-point swings, you can capitalize on a small gain, but then still have some position on. So like if you've got 3 contracts, just taking one off for 2 points and then trailing the second 2 is a really good way to, reduce your risk, grab a little bit of profit, and then at the same time, you can start tightening your stop. So I'm not a big fan of just bringing my stop to break even just because, just the market moves 2 points, it doesn't mean I'm going to bring my stop right to break even. I want to look for things like swing lows, swing highs, prior support and resistance areas that I can put my stop underneath if I'm long, or if I'm short, putting my stop just above a swing high as the trade is developing. That allows for, support and resistance levels that are actually on the chart to come into play. If you just move your stop to break even after the market moves a point in your favor, or if a stock moves 50 cents in your favor, you're just going to end up getting stopped out before the trade really has room to run. And so that's why, especially when I'm intraday trading, using a smaller first target is a way to lock in a little bit of profit, but still keep your stop far enough away that it has room to kind of build some momentum. Another thing that I find really helpful is to look at my trades when I'm doing an analysis in groups. So rather than just looking at one individual trade or one bad day of trading or one good day of trading. If you look at your trades in like the last 20 or 30 trades that you had, that will help smooth out the bell curve. And then when you're making adjustments or tweaks, you're not just getting an outlier of one big winner or one big loser, and then you're not making a tweak based on the outlier. You want to make adjustments based on a bulk of your trade. So the more trades you can gather, the better. And then looking at those trades in groups, I keep a spreadsheet where the left column is winners and then the right column is losers, and it's just sort of a running line item. So I can see, okay, here's a chunk of 4 winners in a row. Here's a chunk of 4 losers in a row, or it's been winner loser. But the time component, I might have 20 trades that are over the course of 5 days, or those 20 trades could be over the course of 10 days. But when you look at them in that column in groups, you get a better sense of kind of the trends that are occurring in your trading. And then I also look at things like R multiple and expectancy, and looking at things like your average profits and your average losses. Those can be helpful ways to put those targets out there. So if you're swing trading in individual stock, you might look at where the trades that you've had in the past, what is the size of those winning trades, and use some of those cues to help, am I risking $1 and making 3? Am I getting out of these trades and then I just see them take off for another $10? Then I really need to make sure that I'm not taking too much off early. And with swing trading, overnight trading, I tend to not take much off at all early on. With stocks, you can be so calculated with, if you're looking at a stock to go long of and you want to get long at $100 and you want to put your stop at $95, the distance between your stop and your entry in this case would be $5. And if you want to risk $500 total on the position, dividing it 5 into 500, you get 100 shares. So your risk is super structured and contained in that respect. And then when it comes to being able to scale out, looking at, okay, if I take a little bit of profit off at 105, that puts that portion, if I take, let's say I buy 100 shares and I take 10 off at 105, that portion is 1-to-1. I risked 5 and I made 5. Well, if we're shooting for closer to 3-to-1 by the time the position is closed, you want to be able to get some of those shares or a big portion of the position, if possible, to get closer to that, making $15 but only risking 5, getting closer to 3-to-1. And so looking at your position, breaking it down into the risk to reward is a really helpful way. Even if you're getting out of your positions a little bit early, you can go back and look at, okay, what would have happened if I stayed in the trade and just took a little bit off as it kept going my way. Even if it's 5 contracts, just locking in profit along the way is a helpful means to getting to some, staying in trades longer. And the longer you stay in those winning trades, the more profit you'll be able to extract. So then when we turn it around, look at the flip side of managing the stop portion, there's really 2 main trail stop techniques that I use. And again, this goes for both swing trading and day trading. So the first one is what I would call an aggressive way to trail. And what I do is simply trail the prior, or like trailing each candle. So if it's a daily chart, I'm swing trading, I would be trailing, if I'm long, I would be trailing each candle's low, just putting my stop below the prior candle's low. If I'm short, I'd be trailing my stop above each candle's high. So say I get long stock and it starts to move higher, and then candle closes, next day we open, start to go higher again, I can put my stop underneath the prior candle's low. If I'm looking at a 5-minute chart on the ES and we open up and we start going lower and I get short, I can just put my stop, one tick above that candle's high. And then as we continue in the trend, I'm just tightening my stop above or below the prior candle. So an example here would be, you're getting long in a position, and as the position goes your way and continues to make new highs, I would just be trailing my stop underneath each candle as long as it keeps going in my favor. And so just using the white dots here as examples on the ES or on all the futures markets, I really just use 1, maybe 2 ticks below the candle's low if I'm long. And then eventually, once a candle breaks that prior one's low, then boom, you get taken out. So you can, especially like if the market starts moving really, really fast, rather than just hit the flatten button or close out of the trade, I find it much more beneficial to take the time to just move your stop underneath each candle's low. And sometimes, like if you're really on a small time frame, looking at a 1 minute or even smaller than that, these candles can be forming super quick. And if the market just starts to sell off fast, or breaks into new highs and just starts to rip, rather than cap your gains, if you just trail your stop underneath each candle's low really, really fast, just by hovering over your trade ladder and just moving your stop up, boom, 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 then a lot of times you can take out a lot more profit rather than just getting scared and hitting the flatten button. For swing trading purposes, the same thing goes. In this case, they're just daily bars. You get long an individual stock and it starts to break out, and then each candle sort of making a new high, but the low of each candle is not breaking the prior candle's low. So the structure of higher highs and higher lows is continuing as long as the trend is continuing. So in this example here with Google, just getting long and then using each candle's low every day once the new candle forms, using that as your stop placement, you can be completely open-ended with your position. Like you don't even have to have a target out there. You can just come in and trail your stop. And there's a lot of times where you can get in a position and you just, each day goes by and you tighten your stop and you tighten your stop under each candle's low, and all of a sudden you're still in the position and you have more upside potential, but your worst case scenario and you're locked in to a big gain is like the worst case scenario. And so that would be what I consider more of an aggressive trail stop, going each candle and tightening it really quickly. On the flip side of that, to look at a little bit more conservative trail stop technique would be to trail above or below the swings. So a swing low for a series of longs, giving the market a little bit more room to pull back and then make a new high before tightening your stop. So If I'm long, I would be trailing in the same way, putting my stop below, but instead of each candle's low, it's below a swing low. And if I'm short, I'm looking for the market to sell off, maybe get a little bit of a bounce, roll over, and then I can use that swing high as a placement for my stop. And again, you can just use one tick above highs or lows for intraday for futures. With stocks, if the stock is trading at 50 bucks, I might use 10 cents. If it's trading at 100 bucks, I might use 20 cents just to give a little bit of a kind of a wiggle room. And here is an example of what that might look like. If you get long and the market rallies and then pulls back a little bit, rather than tightening up underneath each candle's low, you can let it pull back and then break out again, and then use the swing low as your placement. But it doesn't become a swing low until you make a new high. So I would start with my stop, initially on the position, and then as it starts to go my way, it needs to not just pull back, but rally into a new high, and then that solidifies this number 4 here as the swing low. So we have a swing low down here, market comes up, makes a new high, pulls back, breaks out into another new high, and then that solidifies this as a swing low, and then you just repeat that process. Market pulls back, rallies, makes a new high, and then you just move your stop up underneath the next swing low. Rallies, pulls back. In this case, it's just a one candle pullback, makes a new high, same thing. Bring it up under the next swing low, and you just keep doing that until the market makes a deeper pullback, which structurally, if we're in higher highs and higher lows, all of a sudden we break a swing low. Now the market is potentially changing trend, changing momentum shifting, and that's a point where I want to be out of the trade. And so that's the point where I want to place my stop. So structurally and sort of logically, it makes a lot of sense to use the chart as a means of placing my stop above or below support and resistance areas. So a couple little tricks that I use with these two trail stop techniques. The first thing is to be patient at the start of the trade. It's really easy to get kind of to micromanage the position, and sometimes 5 minutes seems like an eternity if you're in a day trade. So I find the best thing to do is to be very patient at the start. I mean, if you have to visualize the trade just stopping you out in the first 10 seconds, like whatever you have to do to kind of calm yourself down so that when you put on the position, you can think clearly and not over micromanage the position. I really find that swing trading is a great place to be a trader. That's how I got my start, actually, was swing trading, and then I moved to day trading. And when you're using daily bars, you have to wait the whole day for the bar to close to be able to manage the position. So it forces you to be patient, and you have to get comfortable not staring at the chart all day long. So you put your order in, you put your stop in, you kind of have your parameters set, and then you got to be able to get up and walk away without thinking about it or coming back and micromanaging the position. So if you can be patient at the start of the trade and not just bring your stop to break even when it's a point in your favor, or the market goes 2 ticks and you take off 5 of your 6 contracts, well, if you're risking 2 points and then you just take half or 2/3 of your position off at 2 ticks, your reward to risk is terrible, and it's not going to get you anywhere at all, really. So a couple things that I like to do. I will wait to move my stop until the market breaks a swing high or swing low. So for using that same example, if I get long a position, I'll leave my initial stop alone until we break highs if I'm long. The exception to that is if we make a double top, then I'll bring my stop up underneath the entry candle's low, or as tight as I can make it underneath the swing low that has formed. So, market pulls back, I get long, market rallies, makes a temporary double top. I tighten my stop one tick below the swing low, and then once we break out, now I can go into sort of trail stop trade management. If you're trading stocks, you're probably going to have more than one share. So it's easy to be able to use multiple stop methods. So let's pretend these are daily bars. You could trail your stop in two ways, meaning you could start trailing your stop conservatively and using the swing lows, and then all of a sudden we break out, we start moving quickly, and if you got 100 shares, let's say you take 50 of those shares and you put a trail stop order just underneath each candle's low on the run up, and market's going up, and then we come back and pull back up here, and you get kicked out of those 50 shares. But then the other half of the position, you use the more conservative stop placement and you trail the swing lows. And so now, you're kicked out of 50 of the shares, and then your other 50, you're trailing swing lows, and you're still in the position. And when you're still in the position, you don't have to put on a brand new position, taking on the full initial risk again. So yes, you may only have half of the position on up here, but there's going to be times where the market doesn't give you a new setup to get in. So I find that even if I'm down to a quarter or a third of my initial position, taking 10 points out of the ES is great, even if you're only down to a couple contracts. Taking 10 or 20 bucks out of a stock, even if you're down to 50 or 100 shares, that's still a decent move. A couple tricks that I'll use is if the candle does not make a new high, then I'll just leave my stop alone. So here we've got candle makes a new high, another new high, and then this candle doesn't make a new high. So I just leave my stop alone. We get a couple of inside bars. None of these candles are making new highs. So if you just leave your stop alone on that temporary pullback or sideways movement, you can stay in the trade by trailing aggressively without getting kicked out just because this red candle broke the prior candle's low. So use that initial breakout bar, just leave the stop alone, and then once we resume to make another new high, then you can start tightening it up again. And then the market gets a little bit deeper pullback, so your aggressive exit takes you out. But if you're trailing in multiple ways, then you can use, you have that conservative stop as well. Yeah, Dan makes the comment that this particular chart, I've got the Heikin-Ashi candlestick study. That's why the trend, I've got the red bar, green bars, but they could be white and black or unfilled and filled. It's not so much about the color as it is about the way that the candles form. So each of these candles is starting at the midpoint of the prior candle as opposed to the exact open of the new candle. So if I'm intraday trading, I like to use the that Heikin-Ashi candlestick study. If I'm swing trading, looking at daily charts, looking at anything above a 5-minute chart, I just use traditional candlesticks. Let's see. So then the other thing to consider is, if you're only trading with 2 contracts, intraday, day trading, let's say the ES, taking 1 contract off at a first target of, say, 2 points, and then just picking one of the trail stop, it's always, let's say, starting with the conservative approach. So you take your first contract off for 2 points. Now you got 1 contract left. You start conservatively, and then all of a sudden the market starts to go straight up really quickly. Well, then you can switch from trailing swings to trailing each candle. So you can kind of react to the way the market or the speed of the market and how it's trading. Therefore, you don't want the market to be 10 points away from your stop, but you want to give it enough room that it can gyrate a little bit or pull back a little bit before just kicking you out. So if you start conservative and then all of a sudden it really starts to rip, you can change gears and just tighten your stop really quickly. Now, if you got 3 contracts, you're in a really sweet spot because you can take 1 off at a small target. You can trail one of the 2 contracts that you have left. You can trail conservatively, and then the other contract you can trail aggressively. And so you get kind of taken out at multiple levels, but you're using the same trade management approach on every single trade. So sometimes you might get into a trade and market goes 2.5 points and then reverses. You take your 2-point target, lock in that profit, and then you get out of the trade, get stopped out of the trade. And then another trade might be a nice runner, but you use the same approach. Goes up, tags that first 2 points, you lock in that profit, you start trailing your stop. And so when you get in this pattern of using a very structured approach to trade management, it takes a lot of the psychological and mind games and second guessing out of trading. And then your job is just to look for good opportunities to get into a trade. Because once you're in a trade, the market's either going to go your way or it's not. And if it doesn't, it's easy. It hits your stop. If it starts going your way, then you have these, couple of techniques you can use to manage the position and, capitalize as much as the market's going to allow. So those are 2, a conservative and an aggressive trail stop technique paired with, using a small profit target and always looking to, how can I tighten my stop as the trade is starting to develop and starting to go my way, giving it a little bit of room at the start, and then being, fairly conservative until it breaks the swing high or the swing low. And that's a good, baseline rule for, okay, at what point do I start to tighten my stop and manage this position? Well, I'm going to wait till we break a swing high or a swing low. So one thing I wanted to kind of close with is 10 things that I find really beneficial for my own trading, and I think you might as well. So a couple things that I like to remind myself is that the market can always go higher or it can always go lower. So even if you are starting to break out and it's the first hour of the day and you're intraday trading, by the end of the day, market might be up 30 or 40 points. And so if you think, this is it, we're at the top, then you'll end up missing a lot of good trending moves. Second thing is, to not tighten your stop too quickly. We kind of touched on that a fair bit. If you can be a little more patient at the start, don't be worried about giving up that 1 point winner, because if you take a bunch of 1 point winners, but you're risking 2 points, that reward to risk is just not sustainable. But if you're risking giving up the 1 point winners to get the 4 or 5 point winners, now all of a sudden you're talking, some really good reward to risk numbers. And that's kind of number 3. It's okay to give up the small winner. Number 4, I like to focus on maximizing the profit out of the trade. So maximizing my winning trades, not necessarily trying to get a whole bunch of winners. So I don't really focus on the quantity as I do more of the quality, and maximize the gains out of my trades, out of my winning trades. And I don't worry about trying to have a ton of trades. I find that trading the same way every single time is a really good psychological trick, I guess, or just a really good way to take out a lot of that subjectivity that comes into trading. I find it really beneficial to go through and analyze the numbers. So like we were talking about, looking at your trades in groups, looking at your R multiple, your expectancy, those are very helpful ways to build confidence when you're trading. It all really does come down to probabilities. And so the more you can use the numbers and use past trades to make tweaks and trading decisions, the better. One thing I've found over the years is that as I trade less, I end up making more. And so I always kind of remind myself that it's okay not to place a trade, and trading less tends to lead to more profits. And that I don't have to make a trade today. I don't need to force anything is a really beneficial way. If you're end up down on the day, it's not a big deal to have a small loss and be down the day. But if you keep trading and you dig yourself a really big hole, you're going to wish you had that small loss versus that monster loss. So not forcing trades if there's no trade setups present is really important. Then the last thing is, just try to keep it simple. Simplify your screen, simplify your strategy, simplify your desk. Try to be as hands-off as possible while still being, discretionary traders. We're not computers, and we're not going to be able to compete with a high-frequency trading firm and, taking 5 cents here and there with hundreds and hundreds and thousands of shares is not really a feasible strategy for an individual trader. Taking 1 or 2 ticks is not a feasible strategy for an individual trader. We need to be able to, take bigger reward to risk so that we can capitalize on, larger moves. And by keeping things as simple as possible, I find that to be a really good way to do that. So the last thing I like to leave you with is there really are no shortcuts for time in front of the trading screen. So it's really important to work smart, but also be patient. The markets are always going to be there. And if you remember, to do the little things each and every day, those little things, those small habits are really what lead to the big success. It's not one trade or one big thing or big decision that you make. It's all those little habits and little decisions that you make each and every day that will lead you to big things.